Everyone thinks this cycle is about to end, and they're wrong. In the next 18 months, we're going to see the largest wealth transfer in crypto history. And it's not because of hype, not because of some magical chart pattern. It's because the structural forces that move the markets is pointing in one direction: extended liquidity. 318 trillion in global sovereign debt that can't be paid back, only inflated away. 9 trillion in US debt refinancing in the next 12 months, and an AI arms race with China that requires us running our economy hot for years. Trump just announced a $2,000 stimulus check that's going to be hitting these accounts Q2 2026. Most people are using a playbook from the 1980s for a game that looks exactly like the 1950s, and they're about to get left behind. For a decade, I taught the 4-year cycle, and it worked. 2013, 2017, 2021, but I figured out something that could change everything. It was never about a Bitcoin halving. It was always about liquidity, and liquidity patterns have just broken out. What I'm about to show you is why we could run this market into 2027. Why every single signal that says the cycle should be ending is pointing the opposite direction. And why people sitting in cash right now are going to watch an opportunity of a lifetime pass them by. Here's what killed the 4-year cycle theory to me. When Ethereum did its merge in 2022, it didn't just cut emissions in half like the Bitcoin halving. It cut it by 87%. I mean, think about that. If the halving theory is correct and you reduce supply, which is the driving force, right? Ethereum should have exploded, became one of the best performing assets in all of crypto. But instead, what did we get? It became one of the worst performers we've seen in years for a large market cap coin. That's when I realized the halving was not the cause. It was not the reason why these markets would go. It was just a coincidence. Something else was the driving force behind these massive moves. The halving just so happened to align with every 4 years. So I went back and I studied what actually happened during every previous peak. 2013, the Fed tapered QE. China stopped stimulus and markets crashed. 2017, the Fed hiked aggressively. China pulled back, the markets crashed. 2021, US and China tightened simultaneously, the markets crashed. Every single time the cycle ended when global liquidity was turned off. It was never about the supply of Bitcoin. It was never about the halving. It was whether about if the central banks were adding water to the pool or they were draining it. And here's the part that changes everything. We are entering the first period since the 1950s where every major economy is coordinated to add liquidity. And this is not for a crisis. This is not for a few quarters. This is for years to come. Because the debt levels and the geopolitical competition gives them no choice. They have to print. US is printing. Europe is printing. Japan is printing. Even China is printing to compete. This is the Cold War 2.0. Just like that era needed liquidity to compete globally, so does this one. And when Americans won't trust Chinese courts and Chinese won't trust American courts, but both sides trust the blockchain, crypto becomes the coordination layer for a divided world. Not just speculation, but the infrastructure. And when everyone's trapped into printing at once, markets don't follow no 4-year cycle pattern. They extend into a massive liquidity explosion. It's deeper than just geopolitics. It's government is trapped from 2 different directions. Both traps force the same outcome: endless printing. The first trap is the debt. During COVID, the US Treasury extended the debt maturity from 4 years to over 5 years. I know it sounds technical, but here's what it actually means. Over the next 12 months, 9 trillion in government debt needs to be refinanced. That's 35% of the entire US economy. If the Fed raises rates and they tighten like they did in 17 and 21, the debt payment is going to explode. The government literally can't afford it. Tightening is structurally impossible right now. And it's not just the US, it's globally. We're sitting here at $318 trillion in sovereign debt. That's not a typo. $318 trillion. No government can pay that back. They only can inflate it away. So this isn't a choice anymore. It's mathematically inevitable that they have to print. They're trapped. They have to keep the rates low, the liquidity flowing. But that's just the first trap. We're in an existential technology race with China. Yes, the AI race is the next trap. China makes 80% of the world's industrial robots. They added 295K last year, the US just 34,000, the UK 2,500. China's power generation went exponentially high in '09, while the US just kind of flatlined. They have the manufacturing, they got the robots, they got the power to scale the infrastructure of AI today. And whoever wins the AI race is literally going to win everything. The CEO of Ford literally said, if we lose this, we don't have a future. I know that sounds extreme, but let me explain, because this is not hyperbole. There's artificial general intelligence machines that are smarter than humans that can arrive here within just a few years. And if China gets there first, it is game over for Western dominance. So the US can't afford to slow down the economy. They can't afford to tight credit. They can't afford to stop building data centers, stop funding the AI companies, stop the build out, which means they have to run the economy hot. Cheap credit, abundant liquidity, stimulus whenever necessary. But here's the plot twist that no one's really talking about. If AI makes us more productive and it's going to displace workers, when a robot taxi company costs 80% less than Uber, what's going to happen to the 8.8 drivers around the world? When Amazon replaces 75% of their 1.5 million workforce with automation, where do those people go? The government will face some really hard choices. Let the mass unemployment destroy the tax base and trigger social unrest, or print money to keep people afloat. Every crisis in the last 15 years, they've chosen to print money. I'm betting they'll probably do the same thing here. They're trapped from both sides. If they have to print money to win the race, they're likely to have to print to manage the consequences of winning the race. This isn't a bug, this is the entire system right now. Now, here's where most people get stuck. They say, okay, but printing money causes inflation and this can't last. Well, wrong playbook, wrong era. Let me show you why this is sustainable for years, and Japan is living proof of this. Japan runs a 250% debt to GDP. That's double the United States of America, and their central bank owns 100% of it. How long have they been sustaining this for? Decades, not quarters, not cycles, decades. As long as the government is spending doesn't directly compete with private sector in ways to drive the price up, the amount of debt created is relatively irrelevant. The post-COVID inflation wasn't due to money printing, guys. It was caused by sending checks directly to consumers during supply chain lockdowns when they could only buy goods while factories were shut and ports were jammed. That was a policy failure, not a printing failure. You ever heard about the Fed's hidden third mandate? Everyone focuses on the Fed's dual mandate, the employment, price stability, but there's a third mandate written into the law that almost nobody talks about: moderate long-term interest rates. The Fed is legally required to prevent long-term interest rates from running wild. Now, translation: yield curve control is coming back. The Fed cannot let the bond market blow up. When regional banks are sitting on commercial real estate loans worth 15 cents on the dollar, and when insurance companies are hiding massive losses, the Fed will step in and they'll just rebrand it. Last time they called it BTFP when they bailed out Silicon Valley Bank, and next time they might come up with a commercial real estate facility or some other acronym. But make no mistake, QE is coming, and it won't be called QE. The Fed balance sheet went from 1.5 trillion to 7 trillion. Next cycle is going from 10 trillion to 15 trillion, maybe 20 trillion, maybe 30 trillion. And here's why that doesn't create a runaway inflation. Velocity of money is extremely low. Dollars are being created, but they're not circulating rapidly through the economy. They're sitting in bank reserves, pension funds, and treasuries. When debt is absorbed by domestic holders, banks, and the Fed itself, the interest payments become stimulus that stay in the US economy. It's a closed loop. This is modern monetary theory in practice, whether they call it this or not. But maybe you're thinking, okay, the macro setup is there, but crypto isn't ready for that kind of scale. Well, you're wrong again. The infrastructure maturity we're seeing right now is unprecedented. Things that took years in previous cycles are happening in months. Major market makers integrated with new chains in 6 months. That used to take years. KYC compliance infrastructure for tokens assets exists now. Retail platforms are onboarding millions of users outside the US. We're talking 90% international adoption in Vietnam, Hong Kong, South Korea. And liquidity? Well, Platforms are hitting 500 million in liquidity, over $1 billion in daily volume within 6 months of launch. Trading infrastructure that used to take years to build are now doing this in quarters. Entire cycles to build, and now it's just happening in quarters. I mean, really think about that. But here's where the real shift happens. It's not just the infrastructure, it's the institutional commitment. Over 170 public companies now hold Bitcoin on their balance sheet. That's 5% of Bitcoin's entire supply locked up by these corporations. This is not speculation, this is treasury management. This is the actual demand that didn't exist in previous cycles. But it's bigger than the institutions. Nations are now entering. El Salvador made Bitcoin legal tender. Bhutan is actively mining Bitcoin, and Argentina has a crypto-friendly governance. The United States signed an executive order to establish a strategic Bitcoin reserve with goals to accumulate Bitcoin over the next 5 years, and they want 1 million of them. And here's the critical part that most people are missing. They're not buying Bitcoin as an investment. They're positioning it as a strategic reserve asset like gold that can be revalued on the government's balance sheet to manage debt. Now, this has happened before. In 1933, the US revalued gold from $20 to $35 per an ounce overnight. 69% increase. That revaluation created billions in the balance sheet value and helped reduce the real debt burden by 15% GDP over 5 years. Now, the mechanism of this was very simple. The government held the gold, they changed the official price, and suddenly their balance sheet looked a lot stronger. But while doing this, the dollar's purchasing power fell to the ground. Now, could they be setting a similar playbook right now for something like Bitcoin? Well, when the US announces that they hold 1 million Bitcoin, it's going to revalue it. The strategic reserve purposes not at 100K, but at 500K or higher, and then the market takes it from there and reprices it again. And when Bitcoin reaches this level, it's not speculation anymore. It's governments using crypto to manage debt crises that they couldn't solve themselves. Now, nations don't operate in these 4-year cycles. They think in decades. Once sovereign enters the framework, they create a permanent bid pressure that didn't exist there before. They don't sell the bottoms like retail does. They don't capitulate like the hedge funds do. They need Bitcoin high to make their balance sheets work. This is a structural shift in who holds economic power and why. And here's the mechanism that's making all this possible. Stablecoins. The US needs to refinance $11 trillion in debt annually. And after Japan and China become net sellers, stablecoins become the solution. Under the Genius Act, every stablecoin dollar must be backed by US treasuries. That's $280 billion in automatic treasury demand, and it's growing by 30 million new users quarterly. Tether alone holds more US debt than Germany. Stripe, Visa, JP Morgan, they're all building stablecoin infrastructure because it solves the debt crisis. But here's the game theory. Offshore stablecoin competition will force issuers to hold harder reserves. Tether already 5% Bitcoin, 120K BTC, and buying more quarterly. When competitive pressure forces higher Bitcoin backing, that creates a systematic demand on fixed supply. Stablecoins buy 3 to 5 years for the debt system, while sovereigns accumulate Bitcoin under 200K. By 2027-2028, they're positioned before other nations compete for a 7-figure Bitcoin. The stablecoin bridge doesn't compete with Bitcoin, it funds the adoption. And beyond that, cross-asset utility. You can use Bitcoin as collateral to trade NVIDIA stock. You can access tokenized real-world assets and meme coins on the same platform. Crypto rails are no longer just for crypto. They're becoming the infrastructure for all financial markets. The total addressable market just expanded from 3 trillion in crypto to every financial market on Earth. And here's what tells you that we're still early. MasterCard, Visa, Stripe, Coinbase, they're all spending billions right now fighting over who controls the infrastructure. That's not late cycle behavior. That's early cycle build out. When trillion-dollar incumbents are still battling for position, that's real inflows that haven't even arrived yet. This is not speculation anymore. It's utility at scale. And that's what supports the extended cycles. Real use case, not just the hype. And if you're still not convinced, look what's happening in real time right now. The bonds are up, stocks are up, gold is up, Bitcoin is up, real estate is up, emerging markets are up. Everything and everywhere, all at once, it's all going up. This isn't normal. This is what happens when deficits get so large, debt gets so massive that the Fed tools stop working. They can't tighten without blowing out a deficit. They can't ease without inflating the asset. So everything rallies because there's nowhere else for the capital to go. Traditional correlations are breaking. Gold and the dollar used to move opposite. Now they move together. Bonds aren't hedging stocks anymore. The old playbook is dead. We're at a turn of an 80-year interest rate cycle. For 40 years, rates fell. We bounced off zero. Even if the rates go sideways now, we don't have anything to offset it anymore. The fiat system has structural flaws that require constant monetary expansion. This is what Wall Street now calls the debasement trade. It's a recognition that current debasement is permanent policy. Wealth preservation requires hard assets. There is no alternative. Central banks have been buying gold at a record pace for the last 3 years. Their stockpiles are at levels we have not seen since the 1960s. They now hold more gold than U.S. Treasuries, and that's not a blip. That's a structural reset. And smart money sees it. Ray Dalio, the founder of Bridgewater, one of the largest hedge funds on earth, is calling for a strong liquidity melt-up before any correction. He says we're in a deep bubble territory, but bubbles rise significantly higher before they break. He's not saying to sell, he's saying to ride the wave. And look at Wall Street. Jamie Dimon, CEO of JP Morgan, still calls Bitcoin a fraud and says he'll fire anyone who's trading it. Meanwhile, his bank holds Bitcoin ETF shares. Their research team is telling clients to buy part of the debasement trade, with 165K as a conservative target to reach gold parity. The CEO is saying it's worthless, but the bank is accumulating. Watch what they do, not what they say. By the time Wall Street flips bullish on camera, they've already positioned. And the biggest bank in the world in America is feeling conflicted. That's not the end of the move. That's the beginning of the move. And the Fed is about to add fuel to the fire. Everyone's calling for a top right now, and they're wrong. And I can tell you exactly why they're wrong. The debt wall hasn't even hit yet. Michael Horwell tracks institutional liquidity flows for about 3 decades, and he found something very interesting. When the rates were at zero, corporations and governments refinanced essentially everything for free money. They kept kicking the can down the road, and now that debt is officially due, and there's no way to pay it back without printing money. The debt wall hits in 2027. Until then, the money printer has to stay on. And Bitcoin's the most liquidity sensitive asset on the planet. When liquidity expands, Bitcoin moves first and it moves the hardest. So when someone asks, why is this market extended? That's your answer. The debt wall is going to force the Fed's hand. This peaks when liquidity peaks, guys. Not when some calendar says so, not when some 4-year chart tells you when it's going to peak. But what makes it even crazier is that Jerome Powell will be out of office May 2026. Trump is going to replace him with someone who's committed to cutting the Fed rate aggressively. And that's exactly when the peak market is going to come from debt pressure. Stimulus will also hit from the tariff checks. Remember those? Right before the midterm election. Liquidity will start to flood the system all at once. This isn't speculation. This is the exact timeline of Q1, Q2. Now, my base case, a top will form somewhere around late 2027. That's 2 years of a really, really good market. Bitcoin realistically can hit 300K to 500K in that window. And that's me actually being conservative. And I'll tell you why I'm being conservative. Run the math on gold parity. Gold market cap is around 20 trillion. Bitcoin is around 2 trillion. Each Bitcoin's already worth $1 million if you match it to gold. I'm not even pricing that in. And here's what most people are missing about institutional flows. When the gold ETF launched, it increased the inflows every single year over a decade, not 4 years, over a decade. Institutions don't follow this 4-year cycle. They DCN slowly, quarter after quarter, year after year. The structural bid didn't exist before. It does now, and it's just getting started. On top of that, digital credit is coming online. Companies like MicroStrategy are already issuing instruments backed by Bitcoin, paying 8% to 10% yield. That's income markets in 300 trillion globally. For the first time, that capital has a doorway to come into Bitcoin. When 1% of that flows in, that's 3 trillion in new demand. At 5%, that's 15 trillion in new demand. It's a flywheel. Bitcoin is scarce and it's just getting started. And you want to see this in action? Look what just happened. Strategy raised 1.44 billion in 12 days. Not to buy Bitcoin, to build a USD reserve that covers 21 months of dividends. They got 74 years of dividend coverage from their Bitcoin just alone. 650K Bitcoin they're holding, 3.1% of everything that will ever be made in BTC. Sailors calling it the first digital credit vehicle. 3 different capital markets they can tap. Equities, commodities, derivatives, all feeding the same machine. This isn't a pitch deck. This is the operating infrastructure right now in a down market while everyone else is panicking. That's a $300 trillion doorway opening in real time. Could I be wrong? Absolutely. Could this be the top sooner? Sure. But right now, with the debt wall still ahead of us, institutional flows flowing from the gold ETF playbook, and digital credit coming online, betting on a traditional 4-year cycle feels like you're betting against gravity. The math is clear. The mechanism is clear. The only question is, are you positioned for it? Look, I don't have a crystal ball, and I don't claim to be right all the time. I've been wrong before, and I'll probably be wrong again. But here's the thing about being wrong. If I'm wrong and this tops in the next few months, you take your profits, you wait for the next cycle, and life goes on. But if you're wrong and this runs into another 2 years and you sold the bottom, what became one of the biggest bull runs in crypto history, you don't get that back. And that's the asymmetry that no one's talking about. Every single bull run in the history has been driven by one thing: liquidity. Show me when a global liquidity expanded, and I'll show you when the crypto market exploded. Show me when it's contracted, and I'll show you when it crashed. It's never been more complicated than that. And right now, every signal is pointing towards sustained liquidity expansion, not contraction, expansion. So the choice is yours. Do you sell because the calendar is saying we're roughly near 4 years, even though none of the conditions that ended the previous cycles are present? Or do you follow the actual mechanism, the thing that was actually driving every cycle, which is screaming in the opposite message? I'm not telling you what to do, I'm telling you how I'm thinking about it. I changed my entire framework because the data changed, the evidence shift, and you gotta shift with it. That's how you survive in this game. Now, could I be wrong? Absolutely. But I'd rather be early to the extension than early to the exit. Because one, it's going to cost you time. The other one literally costs you everything. The market doesn't care about the 4-year cycle. It never did. It cares about liquidity. And that liquidity is just starting to flow. Here's one thing that you need to remember. The US dollar, it isn't real. They're printing trillions of dollars every single year, devaluing the currency. And they're not going to stop. They literally can't stop. The debt is too big. But Bitcoin, it's capped. There's 21 million tokens that forever will be in circulation, and that number is not going to change. So while they're busy printing and devaluing the dollar, look what's happening around us. America is building a strategic Bitcoin reserve, and all the other nations, they're following us. Institutions are piling one by one, and the biggest money in the world are front-running what's to come. Infinite printing meets finite supply, and something's gonna have to break, and it won't be Bitcoin. This isn't a cycle. This is a reset, and the people who are positioned themselves closely will understand what's going to happen next. Time is closing in on what you have to do here, and if you're in for it to win it, you know exactly what you have to do. Because when the dust settles, there's going to be two groups of people. The first group are the people who sold in 2025 because the 4-year cycle told them to do it. The second group are going to be the people who understood exactly what was happening and positioned for it. And then there's the wise men. And you already know, they always get this money.